Good morning. Welcome to the Absolute Wealth Advisors investment update for March. Welcome, Paul. Thank you for making the time and spending our morning together talking about investments and markets, of course. If you don't know who Paul and Dean are in terms of our great photos here, so Paul and I are the founders of Absolute Wealth Advisors. We now support a team of 4 financial advisors to give our clients great strategic and investment advice. And Paul and I help to run the financial planning business that gives great advice to our clients. This is a general advice disclaimer, which it's just important for us to remind ourselves and to remind you, the audience, that things that we discuss here are general in nature. And so obviously this is coming from your financial advisor / your financial advice business. And if anything comes up that you'd like to discuss, we do encourage you to speak to your advisor about the investments that you may be in versus what we might be talking about today or what's going on in the world. They can apply the output from this session to your personal situation. So please reach out to the advisors at any point in time. First and foremost, we'd love to encourage anyone that does have questions while they're listening along to put those in the chat or the Q&A at the top of the screen. So if you're on Teams and you do see the ability up the top to click on the chat button, it's more than happy for you to let us know any questions that you might have. Remembering that those questions don't necessarily be about your portfolio, but just questions about investments in general. We're happy to talk to and answer those along the way. And it just makes for making sure the content is appropriate for you as well. So first and foremost, I'll hand over to Paul now. The first thing that we just wanted to share with you through this process is our investment philosophy. So we've got 8 pillars to our investment philosophy, which Paul will take us through. And this is the key around this is actually how we manage client capital on an ongoing basis. So it's really important for us to have a philosophy and then stick to it, obviously, over time. Take it away, Paul.
Thanks, Dean, and welcome everybody. I think one of the things to remember when we talk about an investment philosophy is that we're talking about long-term investing. Our clients, even if they're pre or post commencing retirement, they've got a 30-year possible investment time horizon. And if they plan to pass on money to their children, then it could be a 50, 100-year investment time horizon. So when we talk about investing, we talk about investing for the long term. And that's contrasted with short-term trading, which we don't try to do, except in extreme circumstances. And some people might think this is an extreme circumstance, so we'll just walk through that today. But as long-term investments, these is our pillars, our guidelines about how we do things. And so the first thing is keep it simple. I've been around long enough. I've been through the GFC. I've been through COVID. I've been through the tech wreck of the 2000s. And in leading up to each of one of those things, a lot of product providers will provide more and more complex products to get into either niche markets or try to provide some protection against the future. And in almost all occasions, those products don't work. They are too fee heavy. They haven't considered all the variables. Complexity doesn't often mean better. So we try to stick to old-fashioned, simple things that we've seen work throughout many cycles and events, and so we know they work. So we stick to the simple things. We stick to our knitting, and we like our clients to stick to their knitting too. I'll explain that in a minute, but we're very good at strategic financial planning, helping clients work out what their goals are, and then coming up with financial strategies to help them achieve that. In doing that, we're not looking at every market at every moment of every day, which is why we can't and don't short-term trade. We pick investment managers with long-term track records of good performance through market cycles, and we let them do the investment management while we do the strategic advice piece. Costs matter. So the higher the cost of the product, there's a very high correlation between high costs and low performance and low costs and high performance. So we prefer low cost investments unless there's a demonstrable reason why not to. Liquidity matters. In these events, if you have enough liquidity to meet all of your spending requirements, then you don't have to sell down your growth assets when markets are volatile. And that means you're not actually locking any losses. If you had 100 BHP shares on day one and those 100 BHP shares are worth $100, and then the market falls by 50% and those 100 BHP shares are only worth $50, you still own 100 BHP shares, so that when the market recovers back up to $1 or $1.50, the value keeps on rising. So you don't want to be selling shares when the markets are down, and the protection against that is have adequate liquidity to meet all your needs without having to sell down your growth assets. So if you go to the next slide, Dean. Asset allocation matters. And what we mean by that is the big asset classes like cash, fixed income or bonds, shares, property, those types are they're the asset classes. And research shows over time that your percentage exposure to each of those asset classes is what drives 90+% of your returns. The manager selection within each asset class has much less impact on your long-term returns. So we very much focus on maintaining and managing asset allocation, and then we're picking our low-cost, good long-term performers in the investment managers, and that is a great combination for good long-term performance. Diversification matters, and that is linked to the asset allocation. Bonds versus equities versus property perform differently in different markets. And so most of the time, the diversification gives you a smoother journey. In some very rare circumstances, everything will fall at once, but even still, they recover differently. So we like to have an exposure to different asset classes over time. That's our diversification. Time in the market beats timing the market. So we avoid reacting to the headlines, and we'll talk a bit more about this later, because all throughout history, we have had market disruptions. But up until this point in history, and it's a long time, markets have always recovered and gone on to grow more. And so if you stay in the market, you'll ride the downturn, but if you don't have to sell, you'll also ride the upturn and typically be better off in the medium term thereafter. If you try to sell, often the people who sell are the people who are anxious and they're worried about what's going on in the market. And those very same people are often too worried to get back in at the right time. And so the behavior around selling out and getting back in typically doesn't work. Volatility matters for income portfolios. This is what we spoke about earlier, if you are drawing income from your portfolio, and that's typically either a self-funded person pre or post-retirement, then you don't want to be selling down your portfolio on a regular basis. And this is where our asset allocation, where we look at your cash flow needs and we put aside enough money that is not subject to market volatility to fund that lifestyle, then you've got a good 3, 5, 7 years of income before you have to start possibly selling down growth shares. And it would be an extremely rare event, and none of the events that we've all lived through have gone on for longer than 7 years. So you'd be back to selling your assets once they're up. So that's our philosophy, and philosophies are the cornerstone of what we do, and they don't change. We don't flip and flop and cherry pick our investment philosophy. It's proven, time-tested, that works through market cycles and market events, and so we stick to these principles when we're investing client portfolios.
Thanks, Paul. And the concept of the risk profile that clients go through when they first meet with their financial advisor and then on a semi-regular basis thereafter, that's helping on an individual level apply our investment philosophy. So we're taking the time to understand obviously where your goals are and your age and stage in relation to the portfolio or capital that we might be responsible for. And the risk profile helps the advisor determine what the most appropriate asset allocation is over time. And so that's both in terms of where you need to get to, but also your attitude and comfort level with taking on additional risks as well. So that's where the role of the advisor helps determine and drive what ends up being the right asset allocation and diversification mix for any individual client. Paul, let's move on to a little bit of economics. So I think both of us studied economics at university before moving into finance. And often these two things, they do go hand in hand, just at different paces or cycles. And so we do like to start with the economics and then the geopolitical side of what's going on in the world. And then we'll jump a little bit more into the markets as well at that point in time. So talk to us a little bit about what you're seeing just in the Australian market at this point in time.
And so the first point there is, Dean, that it is very important to distinguish between the economy, which is all the activity that is going on, and the markets, which are the value of share prices and the interest rates of bonds, because those two things are not always linked. And in fact, there are generally lags on the impact of bonds and equity markets. So in terms of the Australian economy, it's reasonably robust at the moment. If I was to compare where we are now with where we were 6 or 7 years ago, when interest rates were near zero and the government was pulling out all stops to support the economy, we are in a much, much better shape now than we have been in a very long time. Really, it took us a long time to recover from the GFC. Then we got hit with COVID. Then we had an inflationary spike. And all of those things were very destabilizing at an economic and an interest rate level. But we're really back to normal now. Cash rates are there or thereabouts their long-term average. Long-term bonds are there or thereabouts their long-term average. And our equity returns for the last 1, 3, and 5 years are actually stronger than long-term averages. So our starting point is good. Our unemployment is low relative to history. And the only real fly in the ointment really is inflation, which in Australia has been stickier than almost everywhere else in the globe. So everybody will remember we had an inflation spike post-COVID, and inflation and interest rates went up around the globe, and other countries increased their interest rates at different levels and different rates. Australia was at the slow end of that market due to particular differences in how interest rate rises work in Australia versus overseas in those economies. So we were later to rise and later to drop. But around the globe, inflation and interest rates fell quicker than in Australia. But what we're seeing now with a number of issues, from the sort of lingering disruption to food prices from the Ukrainian war and energy prices, we've now got Trump with tariffs, we've got now the war in Iran. All of those things are inflationary. They're putting prices up. And Australia was slower to drop its rates. And those influences in Australia are the same influences that are happening elsewhere. And whereas other countries dropped their rates further quicker, they're now turning to an upward interest rate cycle as well. We've gone from expectations of a few more drops to now, absent the Iran war, we would have been probably in a fairly stable holding pattern, maybe one drop. But now with the Iran war, we're very much starting to look at increasing inflation, and therefore the response from the Reserve Bank will be increasing interest rates. All of that means that the purpose of rising interest rates is to increase costs to the economy, to slow the economy down and squish consumption, so that then prices will come back to normal. So mums and dads are going to feel this. Mortgages are going to go up. The prices of petrol is going up. When petrol goes up, transport costs goes up, food production costs goes up. All of these costs are going to go up, and it's a negative for future economic activity. but that is different to the share market. That's where we're at economically. On a more global scale, the US was looking for interest rate drops, but they're now starting to see inflation come through. So their interest rate expectations have changed. Europe is also having some inflation, but its economy is decoupling from its reliance on the US. And so it's got a lot of stimulus coming from increased defence spending, spending associated with high levels of immigration. They are onshoring or securing many of their supply chains and looking more to non-US distribution and supply chains in order to increase their own security in this new world. So they've got some drivers behind, and this is apart from AI, which is the big theme. Europe has got a lot of drivers driving their economy. I think US has got some headwinds, and I think Australia, as per usual, will benefit from energy prices. But yeah, it's not a terrible situation yet, although we have this issue, which we don't know how it's going to pan out, which is the spike in oil prices.
Yep. Thanks, Paul. And so the inflation, the interest rate increases can, on one hand, hurt a certain number of the Australians in the Australian economy, and then theoretically it can somewhat benefit other people in terms of those that already own their houses and they've paid off and have capital in savings accounts. Obviously, the interest rates will go up on money that's in savings accounts, maybe only marginally and maybe quite lagging where the Reserve Bank takes the rates. I think the most important thing to remember is that although you might be getting a higher return off those assets, we're still faced with that same issue of inflation, being that although you're earning the cash return, we're still facing that situation where
paying more for our
goods and services. And so we've always had that, and this analogy of, although we think that we're doing better, it's actually costing us more along the way. And so we do want to own assets that can benefit from increasing inflation over time. And so my example of that is ending up, if you own Woolworths as a very simple example, when the price of the apple goes up at the farmer because the petrol went up, the farmer's able to put their prices up a little bit, and then Woolworths through the supply chain puts the price of their apples up by a little bit more. And so where does that flow through to the end investor? Is it flows through in that we get higher cash dividends over time. So if that example of Woolworths is looked at over a longer period of time, we would expect the dividends from our growth assets to be somewhat inflation adjusted over time as the economy and those companies end up putting up price rises as they go. There's definitely a lag in that in terms of the price increasing, which is why, unfortunately, interest rate changes is a really blunt instrument to deal with inflation, because it doesn't always affect everyone, and there's a big lag at the same time.
And Dean, that probably is an opaque segue into AI, because yes, if costs are going up due to oil costs, but on the other side, Woolworths can cut costs in their logistics by using AI, then they're able to either buffer some of that price increase so they don't have to pass on all of the energy price increase, which can be good for the economy, or they can actually pass on that price rise but increase their profit margin because their costs have gone down. And so we will talk a little bit at some point about the tailwind from AI, which is offsetting in some degrees the headwinds from the geopolitical events.
Yep, absolutely. So we'll do geopolitical first, just to talk about that in a little bit more detail, Paul, about what's going on in the world and therefore how that actually does impact us, and then we'll have a discussion about AI as well.
Yeah, so one of the first things to remember about geopolitical events are that they tend to have a much shorter run impact on the economy than structural one-in-generation productivity changes like AI. So we can have a look at the Ukrainian-Russian war. There was a short 3 to 6 month impact on shipping, on oil, on agricultural products, on energy prices. But humans are extremely adaptable. And so what ends up happening is the global economy adapts to those conditions. They figure out workarounds to avoid those things that were causing the problems. They find new supply chains, they find new distribution routes, and there are many examples of this. So in almost all occasions, these geopolitical events, particularly wars, are short-term. We have had war in the Middle East, either through Israel or the US or Russia, involved in that region for a very long time. The difference with this event is that it is impacting, in the short term at least, global oil supplies, and that's the shock that we're adjusting to. However, if I'm a betting man, or if I'm gazing into the future and thinking about what the different scenarios are, I would be very surprised if we don't figure out a way around the Strait of Hormuz. Those economies that rely on the sale of oil to drive their economies are not just going to do nothing and stop producing oil and stop the flow of income coming into their countries. And Iran is only one of those countries in that region. And so at the moment, Iran is using its leverage, but it's also cutting off its own nose to spite its face, because if it's not getting any oil out, it doesn't have money to fund its defense. So I suspect that, and we're already seeing some early responses by releasing of reserves, by calling for more international assistance to manage the Strait of Hormuz. And so I suspect that this oil supply issue will be short to medium term, that we will find ways around it. And that could be from basically hobbling Iran's ability to disrupt the Strait. So if they don't have any weapons to use to shoot tankers, then the tankers can go again. It may well be by putting other countries deploying defensive assets in there. It could well be a peace. It could be pressure from other countries in that region to pressure Iran into opening it up so that they can get their oil out. There could be increased productions from other regions which don't need to put their oil through the Strait of Hormuz. I just suspect that there will be workarounds which will release this short to medium term issue, as there have been workarounds to almost every other limited geopolitical event.
Absolutely. And there's that going back to the inflation, Paul, there's a lag both ways in terms of inflation, in that prices may go up as a result of this, but then it takes longer for them to go down as well. So if there's some price increases that get built into the system, they can be a little bit more sticky as a result.
Yeah.
And only 25% of the world's oil travels through that one strip, which is a lot by percentages, but it does go to your point that there's 75% of the oil barrels can travel the world without actually going down that one little strait.
Yes, and Iran as a producer is much less than that, and it only supplies certain regions in the world. The impact is diffused because many countries don't buy oil from Iran.
Correct.
And so
Absolutely.
It's got to be with the transport issue, not the supply of oil.
That's right. And mostly the insurance companies actually voided all the insurance policies on all the ships that are sitting there. So it's not even that the ship is willing and able to actually drive through, notwithstanding it may get attacked, but all the insurance companies have literally canceled or put a hold or cancelled the policies. And that's the driver of why the ships can't go through, is they're uninsured ships, and no one wants to take that risk, obviously, because they've got oil on the ship.
But maybe the US insures that risk because
Correct.
it started the it started the war and it doesn't want this inflationary spike affecting its economy, maybe the US steps in.
Indeed. Okay, so let's talk a little bit about the impact of AI. Obviously, everyone has heard of it. That's an assumption, but you pretty well can't be around without knowing the concept of it. So, Paul, tell us a little bit about how you're thinking that this might impact individuals or individual companies over time, and how that's going to flow through to the economy and share prices.
Yeah, there is a growing consensus that AI is a once in a generational productivity changing technology. And the reason I use those words very carefully is that there are lots of technologies that get high adoption. Take the iPod, for example. That was a very successful technological product, but it didn't change the productivity of the economy. So what we need to do is think of AI more like electricity or railways or the combustion engine or aeroplanes, because those technologies changed the economics of business by massively either shrinking their cost base or expanding their capacity. And so AI has the ability to be both of those things. It has what is the typical journey of one of these once in a generational productivity changing events? Typically, the companies that own the technologies, so think about the electricity companies, think about the rail companies, think about Ford Motor Company, those companies that owned the technology are the ones that have the rise in their prices first. And we can have a look at the rise of NVIDIA, of Apple, Google, Meta, all of those companies that either own the technologies or own the products which drive those technologies, like NVIDIA produces the chips. And some of those other companies own the data centers, which is the processing capacity. Some of them are the creators of AI, but they're the three types of companies that basically own the technology. Those companies have all had massive increases over the last 2 or 3 years. They're known as the Magnificent Seven, but they've all risen. And that's very typical of what happens in one of these productivity transformational cycles. The next thing that happens is that all the other companies that can use the technology to either decrease their prices or increase their productivity, their outputs, they start to deploy that technology, and then their either costs go down or revenue goes up, and they reap the benefits of using the technology. And so we have this initial wave, and then the second wave, which is called the diffusion of that technology through the real economy. And we're already starting to see that. So if you have a look at the earnings forecasts for the other 493 stocks in the S&P 500, they are showing nice, strong earnings uplifts as a result of deploying AI. So overall, this transformational technology is likely to be much longer term, much more diffused through the global economy, and much more likely to dominate the investment markets over the next 10 years than we are these one-off or 2 or 3-off geopolitical events. Yes, they will have a short-term impact, short to medium term maybe, but AI will have a very long-term impact. And we can have a look at, and I know this is a double-edged sword here, but we can have a look at the 1918 through to 1929, the 10-year period, which corresponded with the rollout of electricity and aircraft and rail and stuff, not rail, but mainly electricity and airplanes around transport, that there was a 10-year boom in markets. And there is a book called Coming Into View, produced by the global chief economist of Vanguard, which very much talks about the impact of AI. Probably what we're seeing at the moment is the biggest concern with AI, and there are many, but currently the one that the markets are focusing on at the moment is increasing unemployment. So people losing their jobs to AI. Now, that is a typical scare thought around any of these transformational technologies. Think about the telephone. When the telephone came out, there was something like 340,000 people employed as telephone operators. So they would get the call and they'd take the plug and they'd pull it out and they'd push it through, or they were directory assistants to find a number, etc. When computers came along and all of that stuff could be automated, we're now down to 5,000 phone operators globally. So that industry was massively decimated by computers impacting the telephone technology. However, at the same time, we had computers impacting the accounting industry. And just as one example, fund managers have to reconcile all of the investors buying and selling, and they have to value the units every day by gathering. And that all used to be done by hand. And so Vanguard initially had 75 accountants to do 75 funds. They now have 75 accountants, but doing 500 funds. Now, no loss in employment, but an expanding productivity as a result of that. And actually, accountants, even though a lot of what they used to do, which was the manual reconciliation of numbers, accountants have massively expanded as a profession and the number of people involved due to computers, because they move away from doing the manual entries into doing the more value-added analytical and accounting issues. And yes, there will absolutely be winners and losers out of AI. However, there has always been in history a change in the dynamics of employment and the change in the employment opportunities, which are consequential to the adoption of the technology. And right at the moment, what we're seeing is software as a service. Those companies are laying off people like Atlassian or others. They're laying off because now, whereas it used to take 100 programmers to write some programming, computer programming, to create a piece of software that could be sold on, now they can use AI and get 10 people to do the work of 100. That's definitely an industry which is impacted by AI. But think about nurses and policemen and construction workers and teachers and ambulance drivers, and all of those things are not going to be overly impacted by AI. They might be enhanced such that that the existing workforce can produce more. And remembering, we've got a very stagnant global economy with the aging demographics. So we don't necessarily need a lot of growing employment. We actually need lower workers able to produce more for a more idle growing economy. And so AI might just be the thing that is the savior of the aging of the demographics. So in short, I suspect, and my crystal ball is as fuzzy as everybody else's, but I am doing reading about it from good sources. If anybody wants some books to read on it, I can point you in that direction. But overall, people like Vanguard suspect that the overall benefit of AI will outweigh the negatives, and that it would be positive for share market performance over the next 10 years.
Excellent. Thanks, PB. Very good outline. And it goes without saying that AI may have helped me make slides today, because that's not what I was born to do either. So there are small enhancements as well that make our lives better. This chart that's on the screen now, I'll get you to talk a little bit to it, Paul, but this is from an investment researcher called Ashley Owen. He runs his own company in commentary, but produces a great amount of data and research into the history of markets. And hopefully it's not too small on your screen, but what we are going to point out on the screen is actually just events that have happened in the past. This goes back to all the way to 2000, and the variety of different
Only
events that have happened.
Nino.
2020. Over to you, Paul.
So look, the interesting issue is that since 2020, we had the COVID crisis, we had the inflationary spike post-COVID, we had the Russia invasion, we've had the introduction of AI, we've had the Iran war. But prior to that, we had Israel decimating Palestine, and we've had Trump's tariffs. We've had Trump threatening to take over Greenland. We've had all sorts of geopolitical events. And if we just go back to the start of 2020, which is pre the COVID lockdown, so Dean, you can just put your circle around the starting point.
Yeah.
Then the drop from COVID and then the recovery was less than 12 months. And COVID, we're looking at the red line here, and COVID was a massive global lockdown where we didn't know what the long-term impact would be, but humans found ways to deal with it, and the share market recovered very quickly. So we were back at that point, Dean, it looks like August.
It's like 12,
August.
12 months, yeah.
And then we had the rise in the market thereafter. And then we had the really Russia invading the Ukraine, which was this shock. Now, the peak looks like it was about December 2021, and the bottom looked like it was September 2022. Now, that's 6 months, as far as I can tell, December to 9 months. That's a 9-month shock from something that, for Europe, we didn't really feel it here very much, but a lot of Europe's energy supplies came from Russia, and they didn't know how they were going to maintain the energy grid when Russia was taken offline through sanctions and whatever else. But they did. And so if we then go, so that decline was sort of 9 months, and then, but the recovery to about, let's say, December 23, so that was probably 15 months.
15 months.
15 months in there to recover. And then we've gone materially higher since then. And this event was Trump with his reciprocal tariffs, and clearly that one there. So that had an impact, but really the impact of it was 3 months or 6 months. And then we were back up again. So this doesn't now take into account the war against Iran. But if we could, and we do, we have another graph which shows much longer. But the problem is when you show much longer, you lose the granularity. But this little blue line here is US shares, and this here is 2020. So that part of the graph where the grey shading is through to the end of the year, Dean, you can probably just put 2020. You can put your cursor on 2020.
There, yeah.
So you can see that we've got the COVID impact, then we've got those other impacts that we talked about. But if you have a look at actually how positive that line is from left to right,
which is 1995. That's
1995.
That's where that starts.
Yes, we have impacts, but they always recover, and many of them are short-term events. And so I suspect that what the markets are concerned about is that they don't yet know the solution to the oil problem. But if you were a betting man, it is solvable. It's solvable because Trump could stop the war. It's solvable because Iran could give in. It's solvable because other producers can increase their production and use distribution channels around other ways. It's solvable in so many ways. America could insure the ships. There could be enough ships in Iran that they just become ineffective. There's so many ways which we can solve this problem that I suspect it will be solved. There's enough vested interest between the people who sell oil and the people who want to buy oil that it's highly unlikely to just be a stagnant situation where everybody throws their arms up in the air and says, we don't know what to do.
Yeah, absolutely. And then the final chart that we just wanted to share, just in terms of the reinforcing this long-term returns and reinforcing the concept of long-term compounding returns, is just once again just the index exposures at different asset allocations or risk profiles, as you might know it, between the concept of balanced growth and high growth. The higher the risk that goes to the high growth compared to the balanced. And what we can definitely see when we go back 5 and 10 years in terms of the performance is that these are the 10-year performance ranges between 6 and 10% compounded per annum for the last 10 years, even through all of those scenarios that we spoke about. Obviously not the current one, but definitely tariffs and wars and COVID is all within these numbers that are here in this 10 years. And so that's a very solid long-term return. And if you're talking to your advisor, we don't even use these numbers in trying to forecast where you may end up in retirement. The numbers that we use are more conservative from here. And so that might mean that we may have 1 or 2 years that are lower. But what's important is that we're seeing long-term returns, even as we go through these variety of these short to medium term impacts in the portfolio.
And interesting for investment geeks, Dean, is that if we look at the since inception numbers, that's since 2002. So we now have 24 years worth of information and returns in these numbers. And that includes the GFC, which was the biggest event that we've been through, that took the longest to recover. And these numbers here, the 6.88 for the balance, the 8.02 for the Vanguard growth, and the 8.9, they are much more in line with long-run economic theory about what the returns from shares should be. And so, yes, we get these periods of higher returns, periods of lower returns, but if you're investing for 20 odd years, you are highly likely to be getting returns along these lines. And that was the point of my statement right at the very beginning, is that we're almost all long-term investors. Unless you're looking to buy a house, in which case we wouldn't have you in shares. If you're looking for your money, if you're in retirement, it could last 10, 20 plus years, but that's only for your lifetime. If you have somebody to leave it to, including a charity or children or anybody else, whoever you leave that money to, that extends the investment horizon for that portfolio out another point in time. So in some ways, we're all 50 to 100-year investors. And as you said earlier, Dean, the income part of the portfolio is nowhere near as volatile as the share price. And if we build in liquidity such that you don't have to sell, then you're almost guaranteed. I'll take that back. There's no guarantees in finance, but history would suggest you are highly likely to be getting returns along these lines over the long term. And this is more than enough to fund lifestyles against inflation.
Absolutely. Thanks, Paul. So we're reaching the end of the time that we had allocated to spend with you today, but we're open to some questions, which I'll turn over to in a moment. And if there are any questions, you can just type them in the chat box and I'll confirm them and ask them of Paul. A couple of other events that we've got coming up, which you can find out more details on our website, and also we will be emailing you. So the cybersecurity updates, I run these on a quarterly basis for our client community, which is just about keeping ourselves safe online. So being aware of financial scams that may be in existence coming into our emails and text messages, as well as making sure that we're keeping our personal identifiable information, passports, driver's licenses, and are safe and away from those pesky eyes of criminals. So that's on Wednesday, the 8th of April. Reach out if you need some information about that one. And Anthony, one of our advisors, runs our book club. It's not as famous as Oprah's book club, but it is increasing in popularity. So he runs a book club once a quarter, whereby everyone reads a book somewhat related to finance, but not directly, and hosts a discussion on that.
And Dean,
Thinking Invest is the current. Yeah, sorry.
How do people get involved in the book club if they want to?
Oh, there's a form, and just express the details, and then we'll have them on the email list.
Okay, and just to let people know that the next book that the book club is reading is this book about coming into view from Vanguard. And Vanguard have been very generous in providing a book to every member of the book club who wants to read this book. So if you're thinking of joining, you can get a free book, and it's all about the topic that we were just talking about.
Amazing. Thank you. Thank you, Paul. Obviously, if you want to talk about your personal financial position, first and foremost, you will speak to your advisor about that. But Paul is happy to attend those meetings as well to answer. It was great to spend some time with you. This video will be up on YouTube. So if one of our other clients who didn't attend, please share it with them, and we'll send out a summary via email as well. So thank you very much for attending, and we'll see you next time. Thank you, Paul.
Bye, everybody. Thanks, Dan.